delighted to be able to report very strong and positive results for the year ended 31st of May 2018. We've increased our new business origination by over 70%. We've increased our revenues by almost 80% and increased our profit before tax by over 90%. And all the other key metrics that we use to measure the performance of the business are significantly better than they were this time last year. I think the three fundamental factors that underpin that success are, firstly, our strategy. We've set our stall out to be a multi-product provider of finance to UK SMEs. So that's asset finance, vehicles finance, loans and invoice finance. And we're pursuing what we call a hybrid model, which is to lend on our own balance sheet and to pass business on to other funders. And I think that flexibility and that range of products resonates well with our customer base, and we have more customers coming to us than ever before. And secondly, these results capture the full extent of the enlarged group, so there has been some strong strategic growth in the numbers that we've reported. And thirdly, and most importantly, is that we've seen organic growth of over 30% in the businesses that have been within the group for more than a year. So we're very pleased that those businesses have continued to grow and prosper under our ownership. Market conditions are generally favourable. Overall, we're seeing strong and sustained demand from SMEs. SMEs are genuinely the engine of the UK economy, which is good for our business. In addition to that, on the supply side, we're seeing a good supply of wholesale funding. So that's the funding that we borrow to be able to lend on to SMEs, and we're able to borrow more at a lower cost. The flip side of that additional funding is that there is some price pressure in terms of the interest rates that we can charge to our customers. But the marginal decreases we've seen in price have been more than offset by the lower cost of our borrowing. And I suppose the one pervasive business condition that is there at the moment is the potential effect of Brexit, and in particular a no-deal Brexit. That won't affect us directly because we concentrate on lending to UK companies, but may have an indirect effect from some of our borrowers who trade with continental Europe. And I think what will happen there is that we'll see some lengthening of the supply chain and the delivery schedules for some of our customers. So they may have some cash flow pressures. That's both an opportunity for us, and that enables us to lend more money to those companies, but it's also potentially a challenge in that they may have some difficulty in making their monthly repayments. And our response to that has been to increase our impairment provisions, and we've added £500,000 to our impairment provisions in the results that we've just reported, and we'll continue to increase our provisions over the next few months.
I'm in a very fortunate position to work for a group with so many colleagues who are so committed and talented, from the sales guys at the front end through to the operational teams and the finance guys at the back, that they've helped deliver a set of numbers that I'm delighted to report. Just some of the financial highlights are that our deal origination has increased to just under £143 million. That's an increase of just over 70% on the year before. Our revenue's up to £30 million, an increase of just under 80% on the year before. And our profit before tax has increased to £7.9 million. That's an increase of over 90% on the year before. Our earnings per share has increased to 7.57 pence per share. That's an increase of about 24% on the year before. As we continue to grow and evolve as a group, our balance sheet continues to strengthen, and as at the 31st of May, stood at 48.1 million net assets, an increase of just under 70% on the year before. Our cost of funding has fallen to 4.1% from around 5.3% the year before. Our net bad debt write-off has remained pretty static at around about 1% of the net portfolio. Our own book lending, these are the deals we write on our own book that we originate, has increased to £63 million. That's an increase of just under 60% from the year before. And finally, our funding facilities have increased to £163 million, which is over 2.2 times the level they were at the year before. Drilling down into a bit of those numbers, if we look at revenue in a bit more detail, what's particularly pleasing for us is that all the arms of our business have contributed significantly to the revenue of the group. There's no one area that is being supported by the others or part of the business propping up any of the others. Everyone is contributing significantly, and that's fantastic. If we take the lease or asset part of the business, that contributes about just over 15 million, or roughly 50% of our revenue. The loan part of the business is now at about 10%, just over 3 million of our revenue. Well, the new invoice finance arm of the business has contributed about £6.5 million, or just over 20% of the revenue for the year. And finally, our broke-on business or commission income has just contributed over 5.2 million, or about 17% of the business. I know I'm not meant to talk about 2019, but some potential good news, so I will, as we write business on our own book, the income is spread over the life of the lease or the loan or the invoice finance facility. So we have revenue dropping in future years, whether it be 3 months, a year or 5 years even down the line. And what's particularly pleasing for us is that we have over 19 million of future revenue in relation to 2019 already in the bag, as long as everything goes well. So that puts us in a very strong position going forward into 2019.
Our strategy is now working for our shareholders, that we've been able to report an earnings per share increase of 24%. So our strategy has been to acquire businesses to build scale, and we've acquired 7 businesses over the past 3 years, and 3 of those have been included in the last 12 months. The acquisitions have been funded either through our own cash flow or through borrowings, or for the larger acquisitions in particular, by using our listing and raising equity through the issue of shares, and we're very appreciative of the support that we've had from our shareholders to be able to do that. The placing at the beginning of the financial year was marginally dilutive for shareholders in the 12 months that we've reported, but will be strongly earnings enhancing in this current financial year as the profits come through from the 2 companies that we acquired. The commercial finance businesses in particular, the larger businesses, were positive cash flow in Manchester and Generate Finance in Oxfordshire, and those businesses are performing either to or better than plan, so the earnings will come through strongly in this current financial year.
New business or deal origination is really the lifeblood of our group. It puts us in a position where we can either write it on our own book, or if it isn't quite right for us due to a credit or pricing reason, we can broker it on to other funders out there. So it's particularly pleasing for us to see that the demand for our products has continued to grow during the year, and it was just under £143 million for the year. However, originating deals for the sake of originating deals isn't always a good thing. You've got to make sure it's the right type of deals. If you get too many of the wrong type of deals, your staff can effectively be busy fools, or if you write too many of the deals that are perhaps not the quality you want, you can end up with significant bad debts at the back end of things, neither of which we want. What's particularly pleasing for me is behind these numbers, both of those things we think we've got right. Our staff numbers now stand at about 180 staff as at today, and that's very much in line with where we were back in November. So the growth we've experienced for the back half of the year has been fuelled without really adding to our staff base, so that's great. The guys aren't busy fools, for want of a better expression. Similarly, what we're seeing is our net bad debt write-off remains at about 1% of the net portfolio, which means the business we are writing, the underwriters and the credit control departments and the legal departments are doing a fantastic job in making sure that the business we write performs as we want. And so we're really pleased with those numbers. Similarly, in terms of the quality of the deal we originate, it's very important for what we do that we make sure we have significant spread across all sectors and parts of the country. And what's particularly pleasing for us is that there's no one sector of the businesses we write to, or one region of the country that accounts for more than 5% of our portfolio. And once you get down to about the 10th biggest sector or region in our portfolio, we're down to about 1.5% of the book, which is really very small. So we have a very wide spread of industries and locations across the country, which we think is really important to maintaining our provisioning levels and net bad debt write-offs. Finally, I'd like to just point out the impact of IFRS 9. Without going into too much detail, IFRS 9 fundamentally changes the way that a business like ourselves has to account for lending and the provisions that it needs to have on its balance sheet. We've undertaken some rigorous work both internally and with appropriate advisors over the last 3 to 6 months looking at our portfolio and the risks associated with it. And we were very pleased to announce recently that had IFRS 9 been adopted for the year end we're talking about now, there would have been no material impact. We're very pleased with that because it shows that the robust and cautious underwriting we take, our conservative approach to provisioning, has been borne out in that there's no adverse impact of us adopting IFRS 9 going forward. We can only do what we do thanks to the support of our funding partners, and this year has seen all of our funding partners across all of our 3 divisions continue to support the business to fuel its growth, which is fantastic. Our lease or asset parts of the business are funded by block funders, and they've supported us considerably now. We have half a dozen key block funders with between 10 and 20 million facilities. And particularly pleasing was that we were able to welcome the British Business Bank, or the BBB, into our funding partner mix this year. Now that's particularly good for us because, one, it's a cheaper cost of funding, and secondly, they're government backed, and we had to go through a rigorous process to get on their pool of lenders. and so to pass that was really good for us as a group, so we're delighted with that. The loan business continues to be supported by our high net worth loan note programmes, and our invoice finance businesses are supported by 2 major high street banks with back-to-back facilities. All 3 of these funding arms have significant headroom to enable us to grow and fulfil our ambitions for the next 2 or 3 years. As a board, we've considered dividends significantly over the last year, and I'm paraphrasing slightly, but we have 2 conflicting points of view from our shareholders. Some wish us to pay out ever-increasing dividends, while others say to us, keep the money in the business and use it to fuel growth and generate future profits. We recently came out with a progressive dividend policy, which we think is the best of both worlds. We've announced that we will increase our dividend, what we view as quite significantly, by 30% a year for the next 3 years, which means we are hopefully rewarding our shareholders for the support they've given us and paying more funds out to them. However, we are maintaining the policy of keeping the majority of the funds in the business to fuel growth going forward.
We won't see further growth through acquisition at the pace that we've seen in the last 3 years. We believe we have the product range within the group that we need now to provide the financial products that SMEs require. We have the infrastructure that we need around the country with the 7 sites that we have. We have the capacity to deliver a good service to our customers through our 180 employees that we now have around the country. So the focus now is on delivering further efficiencies from the size of the group that we have, integration benefits where we can, and for example looking at group-wide projects such as the implementation of our systems project that we call Platform One, which will lead us into some new interesting developments in relation to fintech. So that's our focus for the time being. All that said, it's a very fragmented sector. There are opportunities to add profitable scale to what we do, and we'll keep an eye on opportunities that arise, but at the moment we're not looking at anything specific from an M&A perspective. Management have set expectations for further organic growth in the current financial year, and we're already a quarter into the new financial year, and I'm pleased to say that the growth that we're seeing is consistent with those expectations. So with the visibility of earnings that we have from deals that we've already written, plus that sustained demand and the availability of funding that we had from our wholesale funding providers, we have confidence in the outlook for the current financial year. And I think we've signalled that confidence in the increased dividend that we've announced for the current financial year and our progressive dividend policy going forward. And I think that's right to reward the shareholders for their patience and support for the strategic plan that we've delivered over the last few years. And we look forward to increasing shareholder value further.